Okay, well, we mentioned that we're seeing some weakness in the market today, and it comes after a challenging April. Now that we're into May, you often hear that adage, sell in May and go away. But for more on what we can historically take away from what actually happens in the market, let's bring in Sam Stovall. He's Chief Investment Strategist at CFRA Research. Sam, it's nice to see you. Let's just start with the mood of the markets recently. Heading into today's Fed decision, we're seeing a bit of gloom amongst investors. What do you think's been going on?
Good morning, John. Well, I think what's been happening is that investors are now digesting the gains that they experienced in the first quarter. We had early on the S&P 500 recoup all that it lost in the prior bear market on January 19th. We ended up with 22 new all-time highs in the first quarter and also concluded the quarter with the 11th strongest first quarter gains going back to World War II. And each of those indicators then point to a traditional digestion of gains before the market continues to move higher.
And so if you were going to be watching the market reaction to the Fed decision today, would you be interpreting it as the market needing to reassess yet again on interest rates, or is it actually just a common occurrence that when you move quickly, investors will quickly find a few reasons to hit the pause button?
Now, I think that what's causing the investors to hit the pause button is because now they have to be reassessing their expectations. Early in the year, the thought was that the market could experience 4, 5, 6 rate cuts by the end of 2024. We thought that was a bit optimistic. We had 3 on our calendar, but now it's been whittled down to 2 with the possibility of only 1. So higher for longer or slower to lower, whatever terminology you want to use. Essentially, the Fed is data dependent. Right now, the data is implying that inflation remains sticky, the dollar remains firm, interest rates remain elevated in terms of the 10-year yield. And so that is certainly causing a lot of friction for investors who are hoping that, at least in the near term, share prices could continue to work their way higher.
So it's coming at a time when there could be this temptation to take some profits. We're now into May, the adage, sell in May, go away. We were talking about it yesterday, Sam, because when you look back at the last 15, 16 years, I didn't see an overwhelming case for getting out of the market in the months between May and November. But I would love to get your perspective since you're a student of the game of the markets.
Well, you're absolutely right. I've always said that you want to rotate, you don't want to retreat if you wanted to do anything, basically because the market tends to post an average gain of a little more than 2% going back to 1990, which is certainly a lot better than you would get in cash. Also, you would not have to endure a taxable consequence by selling out and then coming back into the marketplace. If, however, you wanted to do something, well, gravitate toward those groups that tend to do well during periods of uncertainty, such as consumer staples, healthcare, utilities, and actually by embracing that kind of strategy, you could have outperformed the market by a 2-to-1 average over the last 30 years. But at the same time, the strategy does beat the market maybe 2 out of every 3 times, maybe even a little bit less, but certainly a little better than a coin toss. So maybe it's a good approach for nervous Nellies who want to do something to protect their assets, but don't want to get out of stocks altogether.
We are showing our television audience a few of your sector ideas there. If there is a rotation of sorts as opposed to a wholesale exit from the markets, what's the kind of rotation you think makes sense these days?
Well, right now we've been seeing an improvement in the consumer staples category as well as utilities. Less so in healthcare. I think there's still an awful lot of pressure from the Inflation Recovery Act and how Medicare drug pricing will affect the pharmaceuticals bottom lines. Energy stocks, we do have an overweight recommendation, but I think right now they are being beaten up by the strength of the U.S. dollar. And so that might take a while before they come into a leadership role once again. But essentially, going for companies with good cash flow, good dividend yields, and stability of demand by consumers, I think is the way investors would want to go during this more challenging 6-month period.
Okay, as for some individual stock ideas, Sam, I know you think more about sectors overall, but like consumer staples, here's an interesting group, has a whole host of different names. It sort of screams safety by design. I mean, there's a lot of companies out there that are focused on more predictable performance, but how do you go about thinking about the kinds of names in the staples sector that make sense in a market like this?
Well, I'm one of those guys a little bit cautious. I try to wear both a belt and suspenders. So I look for stocks that are showing good technicals as well as favorable fundamentals, according to CFRA equity analysts. One of those stocks that meets this criteria is BJ's Wholesale Club. You might think, well, gee, isn't that a retailer? Well, more than 50% of the revenues come from food. So as a result, it's part of the consumer staples category. And also, we feel that it has a broader assortment of products compared with Costco and Sam's Club. And then if you wanted to add to that, look to Molson Coors Brewery. We think that the company will continue to see strong pricing and improved volume in the period ahead. And as the old saying is, when the going gets tough, the tough go eating, smoking, and drinking.
I noticed energy is a sector you're watching as well. We watch it pretty closely. Any pieces of advice on that front?
Yes, well, here's a group that's trading at a more than 40% discount to its average relative PE over the last 20 years. So it's still a very attractive group that offers a nice dividend yield. We have very strong recommendations on both Cenovus Energy and on Murphy Oil, companies that we think could do very well based, certainly Cenovus Energy based on its sands production. Murphy Oil should also see good, healthy free cash flow growth. So companies that also are showing nice technical trends at this point.
All right.